Thank you. Thank you. The most important person in this presentation is the person with the controls. And I hand this over to you to present the controls.
That means I can cut you off when I want to.
You've talked to my wife. Absolutely, absolutely. And I just want to let you know, if this doesn't work well, I have a car running downstairs so I can leave town quickly. It's really an honor to be here. When the search firm came, and this is a good example of a search gone bad, Pat. When the search firm approached us, they told us a number of things, but one of the things that really struck us was, the discipline of knowing when to sell in 2007. And also the ability to push money back from investors. And I told the search firm, this is truly an unnatural act. And out of morbid curiosity, we wanted to come down to Dallas and see what was really going on. And we were totally impressed. And Matt and I have been, and our team have been part of Encore for the last 3 months. And I told Doc this. I just feel it's really a privilege to be here. I've never seen a group that is so well managed and so dynamic and creative, and it's our goal not to diminish the value of this company, but we're very happy to be here, and I'm really excited to meet many of you, and I look forward to seeing you in the future. I'm going to talk a little bit about risk, and investing is about risk and about managing risk, identifying risk, and pricing risk. And so I'm going to talk about some ideas, 8 ideas that I think are kind of interesting. And so with that, I'd like to give you kind of an overview. First of all, I want to ask the question, what is real estate? Now, if I ask most of you, maybe this isn't the case, but if I ask most people what is real estate, they would talk about office buildings, they would talk about bricks and mortar and land and things like that. We have a different view. We look at real estate not so much as a bunch of bricks, but as a basket of financial attributes. And we'll talk a bit about that. Then what we're going to do is talk a little bit about the many faces of real estate. And I know a lot of financial planners think that real estate is REITs, real estate investment trusts. We're going to talk a little bit about the differences between investing directly in property and investing into an operating company through a REIT structure. We're not going to go into depth, but I'm going to give you a sense of the trade-offs and the differences, and that's where we're going to talk about quadrants. The next thing we're going to do is we're going to talk about what is real estate risk and how we should measure it. And people in real estate investing, my observation is that they look at risk and talk about it somewhat anecdotally. I think one of the things that impressed me about Encore is that they're much more rigorous in how they look at risk. Then the question is, once we've identified risk, how do we manage it? How do we mitigate risk? Which risks do we bear, and which ones do we try to transfer to the capital markets? And then there are kind of 2 approaches to investing. And this is particularly true if you have a fund. Now, Encore does not have a fund, but the principles, I think, are very germane to what we do here. The first is the strategic approach. How do you set portfolio targets? And how do you manage those targets long term? And the other is the tactical approach. Timing the market is a good example. And we'll come back to that and we'll talk a little bit about what's happened in the market. And then finally, I want to end on 2 issues. One is, I want to draw some lessons from the crash. What were they thinking? And I want to show you some examples of decisions that were made, particularly up to the point of the crash. What people were saying, and I want to show you some performance graphs and some other things that I think you're going to find absolutely amazing. And then finally, I want to share with you just a snippet of the office property outlook for Dallas in relationship to the US. Next. Okay, what is real estate? I was trained in finance, but also in real estate. But the way I like to look at real estate is that real estate is a hybrid asset. Think for a second about a piece of developable land, maybe a parking lot in New York City or Dallas, or think about a multi-leased property with vacant space. What you have there is a hybrid asset that has bond-like characteristics, the leases, which are a substitute for bonds, and equity-like characteristics. And also a bundle of options. And a good example of that is the option to lease the option to delay, the option to change the use. And so what we have here is a complex portfolio of bond and equity-like instruments in addition with options. Now, the way investors typically look at real estate, they'll think about, well, we have so much in office, we have so much in apartments, and our portfolio is diversified. Sometimes people labor under the assumption that they're diversified when in fact, much like being on the Titanic, just because you're in steerage and the other person is in first class doesn't mean you're diversified, particularly if there's a serious problem. For example, in San Jose, there are certain drivers, technical drivers that are particular to San Jose. And so the question is office and retail, are these complements, are they substitutes? And even if they're highly correlated, if I'm building a portfolio and I look at office and I think office is priced too richly, maybe I can get the same kind of exposure through retail or through multifamily. So by thinking about risk elements, you have deeper insights into doing deals and to building portfolios. And even though, again, we don't have a fund, I think some of these ideas could be very relevant when you think about your portfolio. Next. Okay, let's talk about real estate equity and debt, public and private. And this is an exhibit that I find extremely useful. One of the points I want to make is that anything you can do with non-real estate assets, corporate bonds, traded corporate equity, whatever, you can do with real estate. And what the great revolution in real estate over the last 20 years is the realization that real estate is another component of the capital markets. Now, when we look at this exhibit, what we see is in the debt markets, you have public and private, and in the public debt markets, you have something called commercial mortgage-backed securities. And I spent some time at Nomura engineering these instruments. And the way these are structured is you take the income coming off of a property and you structure it into different classes of bonds that have different priorities. And you've heard of terms like toxic waste, things, weapons of mass destruction. That's what we worked on. And what's interesting about this is that you create substitutes for high-grade corporate bonds, and you create these subordinate tranches, and these subordinate tranches have a very high correlation to what we would consider to be the risk factors associated with real estate. Now, coming down to private, you can invest in mortgages and other kinds of fixed income instruments. Mezzanine, there are funds out there that provide mezzanine debt, acquisition lines, et cetera. So there's different ways of investing in debt through the private markets. Now up here we have REITs and real estate operating companies called REOCs. And a REIT can either trade in the public or the private markets. Well, in the private markets it doesn't trade. But for purposes of this discussion, we're talking about publicly traded real estate investment trusts. And when you invest in a REIT, you're not investing directly in a property. You're investing in an operating company, right? And the operating company can go out to the market, it can raise unsecured debt, it can do a variety of things. Because of the REIT rules, the REITs tend not to do development because they can't trade. They're anti-trading rules. But what they can do is do JVs. And a lot of these REITs did do JVs. And then coming down to here, the private and equity side, we have something called property. And that includes a number of strategies, core plus, value-added, opportunistic, and development. What we do is we do value-added and opportunistic and development. And I'm going to come back a little later and make a very important point. And that is in each of the property teams we have here, we have large experienced teams in each of the areas. What we're able to do in each of the areas, whether it's retail or office, we're able to toggle back and forth between development, opportunistic, and value-added, depending on where relative value is. And we'll get to that in a second. Next. Okay, let's talk now about real estate risk, how we should measure it. The way I look at risk is I look at risk that we can shed into the capital markets, and I look at risk that you cannot shed. Systematic risk are shocks due to changes in interest rates, changes in expected GDP growth, changes in expected credit spreads. Notice I keep using the word expected, okay? And a lot of these risks are, particularly if you're a domestic investor, are very difficult to shed. But there are other kinds of risks that are easier to shed. For example, if you've invested in a portfolio of common stock, the risk that the CEO of Walmart has a heart attack is something you can diversify away, okay? The risk that if you have a large portfolio of real estate assets, that the locality rezones the land. You know, at the deal level, that's a hardship, but at the portfolio level, those kinds of risks can get diversified away. And a tenant default is another good example, are changes in rental growth. So there are two kinds of risk, and risk is unanticipated change. This we can't shed, this is what we have to assume, and this is what we can shed through diversification. Okay, at the deal level, the kinds of risks, there's many kinds of risk. And you hire an investment manager to be able to identify, price, and manage these risks. Some examples, quick examples. At the deal level, property market and submarket risk, tenant credit quality. You know, when we look at corporate bonds, we think of the credit spread. Well, there's actually a credit spread for tenant leases, although it is not, it's not something you can find on the internet. Just because it doesn't, you know, it's not on the internet doesn't mean it doesn't exist. Tenant diversification and default management. This is something interesting, I think, because a lot of people think that they're diversified and they have apparent diversification but not true diversification. They have naive diversification but not true diversification. And a good example is an office building in Houston that has a law firm, an energy firm, a private equity firm. You know, they're all highly correlated. Then the question is, how do you achieve true tenant diversification? It's challenging, and so you have to be able to underwrite tenant credit. So a good investor knows how to do that. Buying below replacement cost. Buying below replacement cost is like altitude to the pilot, and it provides more margin for error. A good issue, though, is what is replacement cost? A firm that used to be very big in real estate was the Equitable, and they built a very, very large, top-of-the-line, AAA hotel in a desert, and it was absolutely the most beautiful hotel that was imaginable. It was the most beautiful hotel imaginable. Thank you very much. But what happened is that hotel, they overbuilt it. And so talking to an investor, they said, well, we can buy that hotel below replacement cost. Well, you know, you can imagine, you know, buying a hotel, you know, in Death Valley, you buy it below replacement cost. You know, is replacement cost zero or is it some other number? So you have to really think through that very carefully. And then barriers to entry. We always look for supply side constraints. Phoenix, there are fewer barriers to entry than New York. But still, you know, people will say, well, you know, there's no more vacant lots in New York. And there's, you know, that's the ultimate barrier to entry. But I always ask people, when was the last time we built a building in New York on a grassy knoll? So you can tear down buildings. So these barriers to entry are not absolute. And then clearly the property life cycle. At what point, where's the relative value? Is it buying the land and entitling it? Is it buying entitled land and developing? Is it taking a package that's already been entitled and doing something else with it? And so part of the investing game is to figure out what works. Next. And then there's capital stack, managing the capital stack. You're going to see that leverage really can enhance return, but there's a difference in value, leverage that enhances value and that which destroys value. The different parts in the capital stack include senior debt, subordinated debt, and equity. And when these all go together, the total value of that should be the value of the property. Now, what's interesting about equity is that equity is like a call option. And a call option has a strike price. And the strike price of the equity is paying off the underlying debt. And what happens in some cases is that the value of a property or even a company can go down so far that there's very, very little equity left. And the management starts to manage the company like in fact the equity is a call option. But there are all these different pieces, and so people who invest, who are successful investors, know how to structure and how to manage that, and they create value by how they manage. Next. Now, I want to talk to you about how to measure risk. Now, risk, as I said earlier, is something that's treated anecdotally. But in fixed income and other areas of the capital markets, we think about it slightly differently. This is a probability distribution, or a histogram, of the NCREIF Property Index. And the NCREIF Property Index is an index representing the returns of institutionally owned real estate in the United States. And what we did is we created this index. The average return is 9.4% over time. And there are some outliers. Some instances where the performance was low and some where it was very, very high. So when we think about risk, we think about risk not only in terms of the average, but we think about it in terms of the spread. All right, and that's a key thing. And unless you think about it that way, you can get into a lot of trouble. So when we look at deals, sometimes we actually model the deal using Monte Carlo analysis, in some cases, and that allows us to understand the spread of the possible outcomes, and it helps us to get a better idea of how to price and manage risk. So the notion here is the return and the risk is measured by the spread. I'm going to come back to that in a second. Okay, now let's take a look at one way to look at capital market instruments, and this is very important. This is something called the security market line. And the slope of this line is determined by a lot of factors in the capital markets. And if you think about it for a second, if this is risk and that's return, and this is zero risk, this would be the risk-free rate on short-term treasuries. And then you could populate this with a lot of other kinds of capital market instruments like treasury bonds, US AAA corporate, all the way up to small cap stocks. Small cap stocks have a lot of volatility, so they're up there, but they also have a lot higher return. So if the market's in equilibrium, all these points should be along this line, right? And it has a slope. And the slope is, the return minus the risk-free rate divided by this little thing called sigma, which is the measure of risk. Next. Now, I want to make a point here, and this is a very important point. We can do anything with real estate, just about anything with real estate, if you think of those quadrants, almost anything with real estate that we can do with corporate bonds and corporate stock. It's just simply another financial asset. And if you look at it, it's the same kind of line here. We have AAA senior debt, real estate debt, commercial leases, which are bond-like, core real estate equity, mezzanine debt, value added, this is where we work, opportunistic and development. Next. Now here's the issue I want you to think about. If this is the equilibrium in the market, we know that the market is constantly getting shocked, right? And so nothing's in equilibrium. Everything's kind of approaching equilibrium. Now there are going to be times when, given the risk, for a value-added strategy, the expected return is much higher than you would expect in the market, if the market were in equilibrium. So that looks like a good strategy, and so is opportunistic. But in this particular case, and it may be for a certain asset class, a certain property type or a certain city, the development is out of favor. Because what I could basically do is, instead of doing this, I could do triple B commercial leases and leverage it up, and I'd get a higher return than doing the development. And this is like a critical point. And the point I want to make to you, and this is one of the reasons I came here, is that I've seen very few firms that can make the distinction. And that's really critical. Next. And so the converse is there are some markets where value added and opportunistic doesn't make sense. And that's, Brad's area. Brad is building multifamily apartments, right? So development for him makes a lot of sense. But maybe doing high-rise multifamily in a lot of other cities doesn't make sense, okay? And he's very discriminating about that. So that's one way in which we can look at the trade-off of risk in a disequilibrium market. Next. Okay, now at the portfolio level, the question is how can we manage and mitigate risk? Okay, now at the portfolio level, you can diversify. And I want to make a point to you. There are a lot, and you're going to see a slide later. It's kind of I hope it's a funny slide, but it's a slide that deals with novel strategies and why they may not work. But the one free lunch in finance that I know, the one free lunch, is diversification, because it allows you to shed risks to the capital markets that you may not want to bear. And the key thing here is that the market only rewards you for assuming risk that you can't shed. Think about that. If you can't shed the interest rate risk, or you can't shed other kinds of risk, and you must bear it, the capital markets presumably will compensate you for that. But it's not going to compensate you for bearing risk that you can shed. So there's this trade-off that people make between risk and return. And in building a portfolio, and we're going to see this in a second, you look for assets. You typically look for assets with a low correlation. Now this makes a lot of sense to you because you're managing portfolios. Your own portfolios or somebody else's. From our standpoint, we're in the business of manufacturing investment opportunities. We don't manage your portfolios. So the other point I want to make is that while diversification can provide a free lunch in the sense that you can shed risk through diversification, diversification is not free. And when I used to advise CalPERS, I used to tell them the one thing you can do is write a big check. And instead what they did is they had many different property classifications, and they had hundreds of properties within each of these. And then they sliced and diced. And it was expensive doing that. So my point to you is that one, diversification is not free, and the other thing is that there's true diversification, and then there's a naive diversification, and you want to use true diversification. The portfolio asset allocation can change depending on what the liabilities are. A safe asset like maybe treasury bills becomes a very high-risk asset in the context of liabilities that are long-term liabilities, or they're synced in some way to commodities. So you have to also think, and we're not going to talk much about this at all, but you have to think about your portfolio in the context of the liabilities. And then there are ways of structuring portfolios to provide downside protection. There are hedging tools, et cetera, but there's all kinds of technology to help you build, manage, and shape the risk of these portfolios. Next. Now, when we go to the deal level, there are lots of risk elements. Entitlements. When does the property get entitled? The issue of co-investment. Acquisition lines. If you have enough capital, you can go out and provide capital market immediacy to sellers. And if you can close on a deal quickly, that means that the seller is probably going to accept your offer even if it's not the high bid offer. Good credit tenants, managing credit. How do you manage credit for non-public tenants? There's ways of approaching that. Working capital management and a whole set of other points. So these are all risk elements at the deal level. Next. So what does this mean? Let's now focus on two aspects of real estate investment. One is strategic management, and the other is tactical. And this is where we're going to make some important distinctions. Strategic asset allocation is figuring out a target, kind of a long-term target that is subject to variation depending on your view of the long term. That's strategic asset allocation. And it's sometimes called the policy mix. And what you do with this is you adjust it over time. Next. And again, back to our security market line, you look for assets that have low correlations, and you try to find ways of combining these. Next. And if you combine them if you combine these in different ways, just with 3 or 4 assets, you can get a frontier called the efficient frontier. And what this is the locus of points such that at any level of risk you have the highest return. The magic of diversification is if you have a couple of assets below the efficient frontier and they have a low correlation, you can design portfolios by adjusting these combinations so that you can be on just about any point of the efficient frontier. But here's the point. If you're here, the beauty of the diversification is that I can increase my return. If I'm below the line, I can increase my return without assuming additional risk, or I can drop risk without giving up return. Once I'm at the efficient frontier, there's no more free lunch. Okay? That's the way to look at that. Now, I'm going to use this. Keep this in mind. This is going to be very important. Next one. Now, as an investor, you have preferences for return and risk. This is the same way you do for kumquats versus apples. There's a trade-off. And you derive utility by that combination. This is called a utility curve, and it shows the trade-off that an investor might have between risk and return. And as he takes on more risk, he or she takes on more risk, they need significantly more return. Next. Now, when you put this all together, this is the efficient frontier, right? And let's say we're in a world where we can borrow and lend. This would be the most efficient point. This is the point where the tangency of the efficient frontier and the utility curve here. But with leverage and with capital markets, what we can do is we can leverage up the portfolio. This is the efficient point on the efficient frontier based on the returns in the capital markets. We can leverage up the portfolio, and we can actually increase the satisfaction or the utility to the investor. So this is a good example of how you can use leverage to make investors happier.
So
Matt.
Randy, I have a question.
Yes.
Can you go back?
Yes.
Where the point where the efficient frontier, the optimal
Yes.
portfolio point, does it represent low risk and low return, or does it represent an optimal mix?
This is an optimal portfolio. If this line were, if we had, let's say, very high interest rates, the line might look like this, right? Depending on what the Fed's doing and a lot of other factors. And so the optimal portfolio would be up here. I thought you were going to ask another question, but I'll ask the question and I'll answer it because I think it's very, very important. What this says basically is that there's an optimal portfolio. Now, there's more than 3 assets out there. There's hundreds of different kinds of assets. But what this says is that everybody basically should buy this portfolio. And then depending on their taste for risk, they can either take on bonds, which is like lending, or they can take on liabilities, which is leveraging, right? But that's what this says. Now, people in the finance business are, financial planners, they're trying to sell different kinds of assets and different kinds of strategies. But in principle, what this says is that using borrowing or lending for an investor, and there's some investors up here and some investors that are going to be down here, maybe widows living off of fixed income, they'll be down here. But what this says is that you can use the capital markets at a portfolio level for an investor to achieve higher returns.
Decrease the volatility of a portfolio.
That's right. You decrease the volatility, and what we can also use is we can use the capital markets. We buy this portfolio. It has some real estate, it has some REITs in it, it has some direct investment in property, and we can buy some bonds. We can hold cash, which brings it down this way. Okay? Now, what we do is we go out and invest directly. You either manage your own portfolios or you have people that advise you, right? We have views on that, but you have people who advise you on the structuring and the management of risk.
All this you're playing is very interesting, but historically, in my mind, I cannot go before 1930s, Depression time. But what we have now is a zero interest rate environment, and it's going to change sometime. Has anybody used that in all these equations? How would that play out?
Well, in fact, they have. There's a lot of controversy on how that's going to play out, and there's lots of journal articles, and people have lots of opinions. But right now we have a very low interest rate for lots of interesting reasons, and what that but this line, in fact, this line may not even be straight, and I think that's the point you're getting at, because of capital rationing and a bunch of other weird things that are still going on in the capital markets right now.
This week in Japan.
Yeah, that's a good example. That's a good example. And so, or else the line is straight and these different assets are on and off the market. And the problem is it's all fuzzy. It's like shooting through a cloud at a target. And so we never really know. In fact, this frontier is a fuzzy frontier. But this I think provides us kind of a general framework. Next. Okay, now let's talk about tactical. If strategic asset allocation is kind of the trunk of the tree, the tactics, some of the things we do, are kind of the things that you hang from the tree, right? And tactical asset allocation is active management of the portfolio. And it's designed to exploit pricing anomalies in the market and other kinds of things. What it allows the portfolio manager to do is to create extra value by taking advantage of certain opportunities, unexploited opportunities that the manager may see in the market. Now, it may be a will-o'-the-wisp, it may be true. But a good example of that is what we do right now. We'll go out into the market and we'll find properties that are in the hands of weak owners. And if we can provide capital immediacy, we can buy these assets at a relatively low price, particularly with regard to replacement. And there are all kinds of tools. Now, you don't have to relegate these tools just to building portfolios. Next, what we do is we use these strategies to every time we look at deals. And one of the things we observe in the market is that there's a lot of mythology about real estate, and we try to be very discerning. Our view is that if it's too good to be true, it's likely not true. If you cannot understand the investment, run the other way. And this reminded me of something that I saw. I actually collect investment strategies that don't make sense and tactical ideas. and I was trying to think, well, what is the image that would best represent that? And so I came up with this. It's called unicorn meat. And just because it's out there doesn't mean it's true. Nature does not like perpetual motion machines, and markets do not like free lunches. And as I said, the only free lunch you're going to get is diversification. Next. Now, a good example of a tactical approach is timing. And this shows the NCREIF Property Index, the annual rate of return for all the institutional properties in the United States. I like this one for a couple reasons. One, it shows the crash here, 2007, and this is the lowest the index has gone since it was started in '78. Encore was founded here, right? And the market was still moving along pretty well. But what I found interesting and what brought me to Encore was this. Encore was a net seller in 2007. And there are very, very few firms that did that. Let me go to the next one. Okay, now, we're going to wrap this up and I'm going to share with you some interesting stuff. Really interesting. What I like to do is I like to look through old real estate magazines. And what I do is I take quotes out. And I figure, well, if I can find quotes from the best and the brightest in the industry, that may tell me something. I may learn something. So this quote is from a fella who is the managing partner of one of the largest private real estate equity firms in the world. My wife said I should not put his name there. He said, January of 2008, it's a great time for folks who have been sitting on the sidelines waiting for the markets to come their way. Commercial real estate prices can correct, but they're not going to crash. Now, let me tell you something, and maybe it's by luck, but Matt and I put together a paper and we gave it to the Urban Land Institute, and there's about 2,000 people in the audience. And we talked about the coming crash, and we characterized it as a Darwinian herd thinning event. Darwinian herd thinning event. And it had such an impact. I was the first speaker of the day. It was characterized by the next panel as if I had backed up a liquid nitrogen truck and sprayed the whole audience. And the rest of the day were people trying to offset this presentation, which we did in late 2006. I look back at it and I thought it was a pretty good presentation. What we missed is trying to figure out the exact timing and also the channels through which it would occur. But this was certainly the received wisdom back then. Also in 2008, the debt markets provide rich opportunities. As one manager said, anyone with a wallet can make money now. Capital flows during 2008 will remain strong. This person is the president of the leading pension real estate consulting firm in the world. This person, March 2008, my Minsky moment was last fall when a friend and highly respected investor told me, in explaining his very aggressive bid and his 5-day due diligence on a $100 million plus deal. Due diligence is for sissies. Anyway, that's the environment. And what happened was when the market backed up in late 2007, we were trying to arrange equity for a $100 million portfolio. This is very quick. I'm talking to the traders on the street. And usually I'd get something back in about 5 minutes, 10 minutes. And a day goes by, 2 days, and I asked him, he said, well, we're having trouble figuring out where the mark should be. And I said, oh, by the way, just out of curiosity, on the debt we're trying to place, what if we wanted to go recourse on it? This is just an idle comment. We've never done that. He said, oh, it'd be the same spread. I turned to Matt and I said, Matt, this is like going to Prudential, getting a life insurance policy and having to pay 0 premium. And at that point, this was August 2007, I said, it's over. It's going to be a problem. Next. So I don't know if you can see this very well. You have to turn off the lights. Can you turn off the lights? At least here. Okay. This, you can't see it too well, but this is Virgil leading Dante through one of the circles of hell. And this is fire and brimstone. Dantes Inferno, the evil counselors. I thought that was fitting. Lessons from the crash. What is very clear when you look at what people were talking about, that crash fell way outside of people's experience and frame of reference. And as a result, people were raising record amounts of money in 2008 because they thought the market had hit a new floor. And they thought they were now in the basement. What they failed to realize was that there were 10 basements under that. Next, the causes of the crash were multiple in number and interdependent. And the commercial real estate industry did not foresee the recession or the crash in 2007 and 2008. And investor styles did not change much from 2007 to 2008. Most investors lost their balance. So when the search firm came and told me about Encore, I said, that truly is an unnatural act. Let me show you how unnatural it is next. Okay, this is the economy as a train wreck. And for those of you who, that's the Gare du Nord, great railroad station. Only a few firms sold assets and held cash. And this chart shows bank failures, right? And if you take it back, early in the 20th century, it never raised, except for the Depression, it never even reached that level. But this shows failures, and this is Encore as a net seller. And this shows transactions volume. What happens in a crash is that particularly with banks can't trust the other banks because we don't know what the value of their assets are. And so what happens is banks stop lending to other banks. Liquidity dries up, and when liquidity dries up, transaction volume falls. And that's exactly what happened in 2008. And when transaction volume falls, what does that do? That means that price discovery fails. And when price discovery fails, it feeds back and volume declines even further. Encore was a net seller in 2007. Next. Now this is particularly interesting. There's an index called the VIX. It's a volatility index, and it's based on the S&P 500. And it's widely used as an index of market uncertainty. It's called the Fear Index, appropriately. This is where Lehman files for bankruptcy in September 15th, 2008. This is Encore selling its assets. Now, I like this one. Excessive leverage. I feel safe up here. Let's go higher. I like this. Building castles with excessive leverage. What happened in 2008, the spreads opened up. This is the spread on AAAs. But look what happened to triple Bs. That's the lowest investment grade credit rating. Look at that. And Encore is a net seller. Lending volume collapsed, spread opened up, and what happened is many owners eager to deleverage were forced to sell their best and most liquid assets. And it created a cascading effect. Next. And if you look at cap rates, real estate people like to think in terms of cap rates, but price is sort of the inverse, roughly the inverse of that. When prices peaked around here, cap rates were at the lowest. In 2007, Encore is mostly out of the market, and then prices fall or cap rates rise. And you can see this for the different property types. What's interesting is that apartments didn't experience anywhere near the price compression that the other asset classes did. Next. And this shows the returns, quarterly returns on the NCREIF index as it falls. And this shows money coming into the market. Remember earlier I said 2008? There was a record number of funds that were raised, and this shows the surge in funds. And most of those funds never got invested. Next. And then finally, with the backdrop of the crash, where are the opportunities today? And I want to give you just with 2 slides, just a snippet. First, today the market is still volatile and it's changing. And that's good for us because, we do value-added and opportunistic kinds of investments. It's a great opportunity. Capital is, in some sectors, scarce. It's hard to believe that, but it's true. So if you find some owners that have bad balance sheets or they want to, maybe they have office and retail and they want to get rid of their office, or they just need capital, it's a great opportunity. Risk management has never been more essential than it is today. Identifying risk and pricing it. Now, what tends to happen with markets is they tend over time to revert to the mean. And what we're now starting to see is the market reverting to the mean. But we think there's like a 2 to 3 year window for a lot of these opportunities. And our view is that what you want to do, even if you're not managing a fund, what you want to do is you always want to have these long-term targets and views about risk. And you want to be constantly examining them and testing it and looking at the market from a standpoint of different kinds of scenarios. And what I'm going to show you is exactly an example of what we do. Next. This shows rental growth for the US and for Dallas. And this is a forecast for Dallas. And Dallas is in red. This is for office. And this is the US. And what's interesting about Dallas is that, it doesn't have the supply side constraints that some cities do, but it has a remarkable growth engine. And this econometric model anticipates over the next 4 years significant expected rental growth in offices. Next. And if you look at Dallas in particular, we have a model that looks at the baseline, a high growth economy, and a deep recession. This is the deep recession, kind of Greek style. And this shows the baseline, and this shows strong growth in the economy. And this is sort of kind of the way I'm looking at the market right now. And what this says is that, there's still, there's, aside from the fact that there's a lot of disequilibrium in the market still, the capital markets are still somewhat in disarray. Aside from that, this seems to suggest, and the other markets we're looking at too are very similar, seems to suggest that we have strong underpinnings in terms of rental growth expectation. And the last one is why we are excited. And we're excited because, the economy is gathering speed. And as the economy gathers speed, more people are going to be buying things and working in office buildings and doing other kinds of things. And the last one is this. And this shows the land of upside down deals. And this is actually Dantes Inferno. And these are the legs sticking out of sulfurous pits of some of Dante's enemies. And I kind of like this because it reminds me of this great slide. And this shows the cumulative distress of all property types from 2008. This has been resolved. This is REO, real estate owned by financial institutions, and this is this troubled real estate. This is part of our strategy. There's still a lot of this out there. And when I look at the real estate market, this says to me, what a great time to be doing value-added and opportunistic investing. And one last. And now it's time for questions. I've talked for a while, but I like this slide because just when you think you've covered everything, you find that you may have missed something. So at this point, I'd like to thank you for your patience, and I'd like to, if there are any questions, I'm here to answer them. Mahesh. Yes, sir, Francis.
Yes, when you were looking at your bell-shaped curve and the opportunities and the distributions, you have to have some kind of mathematical expectation, if you will, and for that you need probabilities. Is there any evidence-based way of determining what the probabilities of something will happen? Or do you have to just go to somebody who's seen a great deal and say, well, I think there's a 70% chance of this or 30% chance of that occurring?
There are a couple of approaches. When you use I'm going to use the word Monte Carlo analysis. It's not something you would normally do in Monte Carlo, on the Mediterranean, but it's a way of, instead of thinking about variables or numbers as discrete numbers, you're thinking about probability distributions. Now your question is, how do you come up with the probability distributions? And there are several ways of doing that. What I did, just for sake of illustration, I just looked at the NCREIF index over time. That's not the correct way. If you're building the inputs, let's say revenues or rents or other kinds of things, or tenant default probabilities. What you try to do is you try to look at similar events and you try to get data and you try to build these probabilities, but sometimes you can't. So what you do is, instead of finding a nice bell, estimating a nice bell curve or something with a lot of skew in it, right? It's non-symmetric. What you can do is you can do the following. Say, look, based on history or based on expectations, I think the worst it's going to be is this number. The best it's going to be is this number, and it's more likely to be this. And you put together a triangular distribution. And it's always imprecise. But what it does start to do is, when you then model in your Excel sheet all of the structure of the deal and all of the other things, what it allows you then to do is, when you look at the output, which is maybe the net present value or the IRR or anything else, it allows you to understand how seemingly inconsequential changes in the contract terms, the JV agreement, or anything can affect the outcome. And then you ask the following question. If I were in your shoes, I'd ask the following question. I really am agnostic about the inputs. I'm not sure what the distributions look like. But given my uncertainty, what I'd like to know is, can I put together a deal structure or a portfolio strategy such that the result is robust, given my ignorance? Yeah. So it's a question of how you apply it, and it's like automobiles. If you put an automobile in the hands of a child or somebody who's inexperienced, it's probably a bad idea. And it's the same thing with all of these techniques.
As a matter of analysis, could you create examples of various probabilities? So you say, okay, this is a 30% probability of something that happened.
Right.
Then you do it again at 40%.
Can you go back to that slide? Let's go back.
And you look at the different scenarios using these hypothetical probabilities to see what fundamentals wind up sticking out that control for that.
Yes.
That even out the risks.
Yeah, we actually can do that pretty easily. You can actually, let's go back, keep going back further. I'm going to answer your question in two ways. I think this is really, go back the other way. There you go, the other way. I wanted to tell you something that I had omitted. Let's assume that this is the right probability distribution, the right estimate of risk. Let's assume that. The great thing about this, and let's say this is the output on the net present value on the deal, or the IRR. What this allows us to do is ask the following question. This is a zero return here. And what it says up here is that if you integrate under this, this should equal 100%, right? Because if this involves all of the potential outcomes, it has to be 100%, right? Okay, what this says here is, what I can do is, by measuring the area under this curve, this says to me, over time, there was 11% of the time that there was a zero rate of return on this. Now, what I can do with this is, I can define, let's say we have a very simple problem. We have revenues and we have expenses, and I define the distributions for each. And then at the very bottom, where the cash flow comes out, I divide it in two ways. I have one tranche called preferred, and they get 50% of anything positive. And then the other is the rest. And you get those distributions. Now what I can do is, when I put the model together with the distribution for the rents and the expenses, what I do is not only come up with the distribution, but I also can define the correlation between them. And this is really important. When most people do Excel analysis of deals, companies, whatever, most of the stuff we did on the street, it was deterministic. But in the derivatives area and fixed income, we use these techniques. Because what it allows us to do is it allows us to explicitly incorporate risk and the correlation among these distributions. And what you sometimes get are very surprising results. You think you've structured the deal so that it has very low risk. And in fact, there may be risk elements that you haven't considered. Now, the objection to all of this, people say, well, you're making a lot of assumptions. Well, you're making assumptions explicit. You're not hiding it. I remember when I got into real estate in 1980, I was going down the street with somebody from the UK. And we were looking at buildings. And this was just when they were doing lease-by-lease analysis. And he said to me, Randy, he says, you know, we don't need a college professor to tell us how to value buildings. I said, I just have a cap rate. I take the net operating income and I cap it. Yeah. So I asked him a couple of things, and eventually he became a convert. But the thing is, back then, he said, oh, all this stuff, you're making assumptions. I understand, but what he was always doing, they were making the same assumptions, but they weren't explicit. I've raised billions of dollars of capital, and I worked on all kinds of deals. I worked on the securitization of Rockefeller Center and stuff like that. And I look at a lot of this as kind of a framework for thinking about the world. It's a framework, and it suggests the questions, right? You can't be a slave to this, right? And so I look at it as kind of a guideline. I one time told a developer, I said, you're really in the business of managing a portfolio of options. And he looked at me and he said, what? He had gnarled fingers and all of that. He'd gone through one of the crashes. And I said, no, you really are. You have this intuition. And I kind of explained what he does. And he said, you're right. Now that I understand that, I am in that business. People who are great investors, whether it's a Warren Buffett or a great developer, they have this intuition about these things. And while, some of us are in the back room trying to work out formulas and things like that, these people are out there at the barricades, and they just have this intuition. So they're buying options that are cheap, and they're selling options that are expensive, and they're constantly doing that. And they have this intuition. And the greatest developers I've ever met know how to do that. And so while this is a framework for thinking about things and sensitizing you to some of the issues, there's no substitute for experience. But this kind of stuff can sometimes get you through those parts of the market where experience is lacking, i.e. in a crash. So it's important for a good team to have access to both.
Thank you. And with that,
Thank you.
Randy, really appreciate it. Good job.
Thank you.